If you take a train into the quiet industrial city of Basel, Switzerland, and walk toward the main station, you will notice a building that feels completely out of place. It is a brutalist, cylinder-shaped skyscraper rising more than 230 feet into the sky, resembling a nuclear cooling tower rather than an office building. This strange structure is the headquarters of the Bank for International Settlements, known as the BIS. The BIS is often called the most exclusive club on Earth. Its members are not individuals, politicians, or corporations. Its members are central banks. The Federal Reserve, the European Central Bank, the Bank of Japan, and many others regularly send their top officials here for closed-door meetings held every 2 months. What makes this building even more unusual is that the land it stands on is technically not Swiss territory. Like an embassy, it has a special legal status. It has its own security, its own police force, and its documents are legally untouchable. No court anywhere in the world can demand access to its records, and its officials enjoy full diplomatic immunity. In practice, it operates like a sovereign state dedicated entirely to money. Inside this tower, behind heavy doors and inside wood-paneled conference rooms, a small group of unelected technocrats quietly designs the rules that govern the global banking system. These rules are known as the Basel Accords. They are invisible laws that decide how much banks are allowed to lend, how much risk they can take, and whether the global economy experiences growth or collapse. If you want to understand why your mortgage application was rejected or why the financial system nearly collapsed in 2008, you don't need to look at Wall Street. You need to look at the Tower of Basel. The story of the Basel Accords begins with a failure. In 1974, a German bank called Bankhaus Herstatt collapsed in a chaotic and poorly managed way. The collapse happened in the middle of the trading day. Because of time zone differences, American banks sent payments to Herstatt in the morning, expecting to receive funds back later in the day. But before those payments could be returned, the bank shut its doors. The money effectively disappeared. Panic spread, and the global banking system briefly froze. This event exposed a critical weakness. Banking had become international, but regulation was still national. A bank failure in Germany could damage banks in the United States. There were no global standards, no shared safety rules, and no coordination between regulators. Recognizing the danger, central bankers from the G10 nations formed a new group called the Basel Committee on Banking Supervision. Its mission was simple but ambitious: create global rules to ensure banks held enough capital to survive a financial shock. For nearly a decade, the committee debated and argued. Finally, in 1988, it released its first framework, later known as Basel I. The document was only about 30 pages long, but its impact was enormous. The core idea was the capital adequacy ratio. Every bank was required to hold capital equal to at least 8% of its assets. If a bank lent out $100, it needed $8 of its own money as a buffer against losses. At first, the rule sounded sensible and responsible, but the real consequences came from a new concept introduced alongside it: risk-weighted assets. The committee acknowledged that not all loans carry the same risk. Lending to a government is generally safer than lending to a new business, so assets were divided into categories. Government debt was given a 0% risk weight, meaning banks were not required to hold any capital against it. Residential mortgages were given a 50% risk weight, while corporate loans were assigned a full 100% weight. This mathematical framework quietly reshaped the global economy. By declaring government debt essentially risk-free, the Basel rules encouraged banks everywhere to buy sovereign bonds. Lending to governments became cheap and attractive, while lending to businesses became expensive. Governments found it easier to run large deficits because banks were eager to hold their debt. At the same time, housing markets expanded rapidly because mortgages required far less capital than loans to productive industries. Basel I did more than regulate banking, it distorted incentives. Banks gradually shifted away from funding factories, innovation, and small businesses, and instead focused on real estate and government borrowing. But banks are highly adaptive institutions. They studied the rules carefully and soon discovered a loophole. If a bank sold a loan instead of keeping it on its balance sheet, it no longer needed to hold capital against it. This loophole gave rise to the modern securitization market. Banks could originate loans, bundle them into securities, and sell them to investors. Once the loan was sold, the risk disappeared from the bank's balance sheet, freeing up capital to issue even more loans. This model, known as originate to distribute, meant banks no longer cared deeply on loan quality. Their goal was no longer to ensure borrowers could repay, but to move loans off the books as quickly as possible. This behavior was not accidental. It was directly encouraged by the Basel I framework. Banks were simply optimizing their mathematical rules. Over time, this system created enormous volumes of complex financial products backed by questionable loans. The seeds of the 2008 financial crisis were planted not in greed alone, but in the structure of global regulation itself. By the late 1990s, it was clear that Basel I was too simplistic. Risk could not be neatly categorized into a few boxes. The system was crude and easily manipulated. Regulators acknowledged that the rules needed to evolve. Once again, the committee returned to the tower in Basel to design a more sophisticated framework that they believed would finally make the global banking system safe. That effort would eventually lead to Basel II, a much more complex system. But before it arrived, the foundations laid by Basel I had already reshaped how banks behaved, how governments financed themselves, and how risk was quietly building beneath the surface of the global financial system.
When Basel I was fully absorbed by the global banking system, its weaknesses became impossible to ignore. The rules were too blunt, too simple, and too easy to manipulate. Banks had learned how to play the regulatory game, not by becoming safer, but by appearing safer on paper. Regulators in Basel understood this, and they believed the solution was not fewer rules, but more sophisticated ones. Throughout the 1990s, the Basel Committee returned to its conference rooms and began designing a new framework. The goal was to measure risk more accurately and to align capital requirements with real-world dangers. After years of negotiations, the result was released in 2004 as Basel II. If Basel I was a thin booklet, Basel II was a massive technical manual filled with formulas, models, and exceptions. The central idea behind Basel II was that not all borrowers deserved to be treated the same. Instead of assigning every corporate loan a fixed risk weight, the new system relied heavily on credit ratings. If a company or a security was rated highly by agencies like Moody's or Standard & Poor's, banks were allowed to hold less capital against it. If the rating was lower, the capital requirement increased. This change quietly handed enormous power to 3 private credit rating agencies. The safety of the global banking system now depended on opinions formed in offices thousands of miles away from the borrowers themselves. Regulators trusted that these agencies could accurately assess risk. Banks trusted them even more because higher ratings meant lower capital costs and higher profits. But Basel II went further. Large international banks argued that even the rating agencies were too crude. They claimed that their internal risk models, built with advanced mathematics and powerful computers, could measure danger more precisely than any standardized rule. These banks insisted they understood their own portfolios better than regulators ever could. Regulators accepted this argument. Under the internal ratings-based approach, the largest banks were allowed to use their own models to determine how much capital they needed to hold. In theory, regulators would supervise these models. In reality, the system relied heavily on trust. Banks were effectively permitted to measure their own risk and report the results. The outcome was predictable. Internal models consistently produced reassuring conclusions. Risk appeared low, volatility seemed contained, and capital buffers were reduced to the thinnest possible levels. Balance sheets were optimized for return, not resilience. Banks congratulated themselves on their efficiency, believing their equations had finally tamed uncertainty. Basel II was implemented most aggressively in Europe. Just as the rules came fully into force, European banks began buying massive quantities of American mortgage-backed securities. These instruments were packed with subprime loans, but they carried the highest possible credit ratings. Under Basel II, a security stamped AAA required very little capital. It looked safe, scientific, and profitable. This created a dangerous illusion. Banks held billions of dollars in assets that appeared almost risk-free under the regulatory framework. On paper, capital ratios looked strong. Regulators were satisfied. Executives were rewarded. But the real risk was hidden beneath layers of assumptions and models. When U.S. housing prices began to fall, the illusion shattered. Mortgage defaults rose, and the value of complex securities collapsed. Credit ratings were slashed. Internal models failed catastrophically because they were built on historical data that assumed housing prices rarely declined nationwide. The supposed safety of the system vanished overnight. Banks discovered that they had almost no true equity to absorb losses. The capital they believed protected them was largely an accounting mirage. The system designed to prevent crises instead had concealed one of historic scale. In 2008, global finance stood on the edge of collapse. The failure of Basel II was not subtle, it was devastating. The framework relied on assumptions that proved disastrously wrong. Risk could not be outsourced to rating agencies. Mathematical models could not predict human behavior during panic, and allowing banks to police themselves created incentives that no regulation could overcome. In the aftermath of the crisis, there was anger and disbelief. Governments were forced to rescue banks with taxpayer money. Economies entered deep recessions, yet despite this, regulators did not abandon the Basel system. They argued that global coordination was still necessary. The mistake, they said, was not regulation itself, but regulation that was too weak. Once again, the world's financial architects gathered in Basel. This time, the atmosphere was different. The crisis had shaken confidence in markets and in the banks themselves. Regulators were no longer willing to trust internal models or optimistic assumptions. They wanted rules that would leave no room for interpretation. The result was Basel III. Finalized in 2010 and gradually implemented over the following decade, Basel III aimed to fundamentally reshape banking. Capital requirements were raised significantly. Banks were forced to hold higher quality capital, meaning equity that could truly absorb losses. A leverage ratio was introduced to limit total borrowing regardless of how safe assets appeared. But the most important change under Basel III focused on liquidity. Regulators concluded that many banks had not failed because they were insolvent, but because they ran out of cash. When confidence disappeared, even healthy balance sheets became meaningless if assets could not be quickly converted into money. To address this, Basel III introduced the liquidity coverage ratio. Banks were required to hold enough high-quality liquid assets to survive 30 days of extreme stress. These assets had to be immediately sellable without significant loss. In practice, this meant cash and government bonds. On the surface, the rules seemed reasonable. An emergency reserve for banks sounded like common sense, but in finance, every rule changes behavior. By redefining what counted as a good asset, Basel III reshaped incentives once again. Government debt became the most valuable asset a bank could own, not because of its return, but because of its regulatory treatment. At the same time, loans to businesses were classified as illiquid and penalized. Lending to the real economy became less attractive, and banks began to behave less like engines of growth and more like vaults for sovereign debt. Safety increased at the level of individual institutions, but flexibility was quietly removed from the system. The architects of Basel III believed they had finally built an unbreakable structure. Stronger capital, stricter leverage limits, and massive liquidity buffers would prevent another collapse. Yet in solving the problems of the last crisis, they may have created the conditions for the next one.
Basel III did not end the story. In many ways, it only pushed risk into places regulators were not watching. As banks were forced to hold more capital and liquidity, they began to retreat from activities that consumed balance sheet space. The financial system did not become smaller, it simply changed shape. Risk migrated away from traditional banks and into what became known as the shadow banking system. Shadow banks were not dark or illegal institutions. They were investment funds, money market funds, hedge funds, and structured vehicles that performed bank-like functions without being treated as banks. They borrowed short-term, invested long-term, and promised liquidity in environments where liquidity could vanish instantly. Yet they operated outside the strict capital and liquidity rules imposed by Basel III. Regulators were aware of this shift, but they underestimated its speed and scale. Capital constraints made banks cautious lenders, while markets demanded constant credit. The gap was filled by non-bank institutions willing to operate with thinner cushions and higher leverage. Officially, the system looked safer. Unofficially, fragility was rebuilding itself in new forms. At the same time, banks learned how to adapt to the new rules. They did not openly defy regulation. Instead, they optimized around it. Balance sheets were reshaped to maximize regulatory efficiency. Assets that carried low capital charges were favored, regardless of their underlying economic value. Government bonds, treated as nearly risk-free, became central to bank portfolios across the world. This created a quiet dependency between governments and banks. States relied on banks to absorb massive amounts of public debt, while banks relied on governments for regulatory protection and liquidity classification. The system became tightly interconnected. A shock to sovereign debt markets would no longer affect just governments, it would ripple directly through the banking system. Central banks reinforced this structure. Through quantitative easing, they flooded markets with liquidity and purchased government bonds on an unprecedented scale. Interest rates were pushed towards zero, and in some countries below it. These policies stabilized markets, but they also distorted prices. Risk was suppressed, not eliminated. Low interest rates forced investors to search for yield. Pension funds, insurers, and asset managers moved into riskier assets to meet return targets. Valuations climbed, debt accumulated. The system became dependent on continuous support from central banks. Stability was maintained, but only as long as intervention continued. Basel III assumed that stress events would be temporary and manageable. It imagined 30-day liquidity crises, not multi-year periods of disruption. It assumed markets would always remain deep enough to sell government bonds without loss. These assumptions were rarely questioned because challenging them would undermine the entire framework. Then real-world stress tests arrived. The COVID-19 pandemic froze global commerce almost overnight. Markets panicked. Even government bond markets experienced moments of illiquidity. Central banks were forced to intervene aggressively, acting as buyers of last resort. Liquidity did not come from bank buffers, it came from extraordinary policy actions. This raised an uncomfortable question. If the system still required massive central bank intervention during crisis, what had Basel III actually accomplished? Banks were better capitalized, yes, but the system as a whole remained dependent on external rescue mechanisms. Regulation had shifted the burden, not removed it.
In response, regulators began discussing further reforms, often referred to as Basel IV, though the name is unofficial. These changes aimed to limit the use of internal models even more and impose standardized capital floors. Once again, the goal was to close loopholes discovered by banks, and once again, complexity increased. Each new layer of regulation made the system harder to understand. Transparency declined, even as reported safety increased. Risk did not disappear, it became harder to see. Financial stability turned into a technical discipline understood by specialists rather than a simple question of resilience and common sense. Meanwhile, banks became less willing to lend during uncertainty. Capital preservation took priority over economic support. During downturns, credit tightened precisely when it was needed most. Governments stepped in with guarantees and fiscal programs, effectively socializing risk once again. This cycle revealed a deeper truth. Modern financial regulation struggles with incentives. Banks are profit-seeking institutions operating within rulebooks designed to restrain them. Every constraint becomes a variable to optimize. Safety measured by ratios can improve while real-world vulnerability grows. The Basel framework was never designed to eliminate crises. Its true purpose was to make crises manageable and prevent complete collapse. By that measure, it may be considered a success. Banks today are stronger than they were in 2008. Failures are less likely to cascade instantly across the system. But the cost of this stability is subtle. Credit is more centralized. Markets are more dependent on policy support. Governments and banks are more intertwined than ever before. And risk has become increasingly political, shifting from private balance sheets to public ones. The future challenge is not writing another set of rules. It is understanding how rules shape behavior. Regulation cannot replace judgment, nor can models replace uncertainty. Financial systems are human systems driven by confidence, fear, and incentives that change over time. As long as profits are private and losses are socialized, risk will seek new hiding places. It will move through regulations, around safeguards, and into areas that appear safe until they are not. Basel I, II, and III each tried to impose order on this reality. Each succeeded in some ways and failed in others. The story of Basel is not a story of incompetence or malice. It is a story of limits, the limit of foresight, the limit of models, and the limit of believing that stability can be engineered once and for all. The next crisis will not look like the last one. It never does. It will emerge from the structures built to prevent it. And when it does, regulators will once again return to Basel, searching for new rules to solve problems created by the old ones. That cycle, more than any specific regulation, defines the modern financial system.